Welcome to USMK Insights, where we focus on US stock technical analysis. Using charts, trends, and price action will help you understand the market rhythm and make informed buy and sell decisions. Alright, hit subscribe and let's begin today's learning journey. Today, we will continue discussing reversal patterns. Reversal patterns are crucial for identifying trend changes. They help us spot turning points in the market. By recognizing them, we can identify major lows or major highs. If we can spot reversal patterns, we can catch the opportunity to spot near the top or buy near the bottom. This is very helpful for short-term and swing traders. It gives us an edge. So let's continue to focus on short-term trading strategies. Today, I will introduce a practical reversal pattern, the inverse head and shoulders pattern. So what is an inverse head and shoulders pattern? Let's look at this area on the chart. First, there's a sustained downtrend, then the price rebounds, but it drops again, making a new low. Another rebound follows. This rebound falls to break the previous high. Then we see another pullback. At this point, this is ahead. This is ahead of the pattern. Here is the left shoulder, the left side, and here is the right shoulder, the right side. Just like a person's shoulders, the head is in the center, upside down. Above this is what we call the neckline. This area is a neckline. So this pattern gives us a clear signal. A head, a left shoulder, and a right shoulder, and the neckline above. So when the price breaks above the neckline, that usually confirms a trend reversal. That's a basic way to identify an inverse head and shoulders pattern. Now let's look at a real example. I will walk you through the details. First, notice this reversal followed by a decline. Another pullback with the downtrend continuing. The price keeps dropping. At this point, we finally see a rebound. There's a 3-day rally with 3 consecutive bullish candles. However, bearish pressure remains strong. The rebound falls and the price pulls back again. The market makes a new low. This wipes out earlier buyers at this level. Those who entered earlier are now trapped in losing positions. Many traders are now stuck holding losses. At this point, the downtrend is still intact. Let's look at these two lines. On the left side of this line, the market stays in a clear downtrend. It's a strong bearish move. If we ignore the right side for now, can we predict if a rebound will happen after this point? It's not obvious, right? So at this stage, is there a chance for reversal? We don't know yet. Let's go step by step. How do you spot these turning points in real time? Based on your own experience, you may have seen similar setups in your trading. When this happens, how do you decide which spot is a good entry? Let's walk through this example step by step. On the left side of the line, the market is in a strong downtrend. Prices keep making new lows. The downtrend is very obvious. Bearish momentum is strong. The sellers are clearly in control. But what about the right side? We don't know yet. Let's keep going. Let's stick to this method. Now looking here, after making a new low, the price starts to rebound. This helps ease some of the bearish sentiment. Previously, the market saw a sharp one-sided drop. Now at this point, there's a rebound lasting about 2 to 3 weeks. At this stage, even though it hasn't break above resistance, because this rebound has lasted longer, we can clearly see bearish pressure is weakening here. The sellers are not as aggressive as before. Earlier, bearish kept pushing prices to new lows, but during this rebound, we can see from the price action that at this level, there are buyers stepping in. Many traders are starting to bottom fish here. That's why we see a rebound lasting about 3 weeks. It's because of buying interest at this level. This explains why the rebound continued for several weeks, right? So this marks a shift from a strong bearish trend to a state of equilibrium. Now the bulls and bears are evenly matched. It's a balanced market. We can't say the bulls have fully taken over yet, but it's clear that previous rebounds lasted only a few days. Then sellers would push prices lower again. The downtrend would quickly resume. Sellers dominated. Prices kept falling. But this time, the rebound lasted 3 or 4 weeks, not just days. That's a clear difference. It tells me the bulls are gradually gaining strength. The buying power is increasing, while bulls haven't completely overtaken the bears. At this point, they're at least able to put up a real fight. It's a real contest, like a boxing match. Not a kid against a professional, but two skilled fighters. Both are capable, so the battle is intense. It's a fair fight. There may be a difference in skill, but either side could still win. And the competition is exciting to watch. It's not a one-sided rout anymore. Do you see the difference? Does this explanation make sense? At this stage, bullish momentum is gradually building. Buyers are getting stronger, sellers are losing strength. So we have shifted from strong bearish control to a more balanced market. Now it's more range bound. However, the bears still haven't been completely defeated because the price hasn't broken out yet. From the perspective of Dow theory, how do we confirm a trend change? When a stock price rises above the starting point of the last major drop, that starting point is here. This is the origin of the decline, the lowest point that triggered the last sell-off. If the price moves above this area, where the last big decline started, that's when the trend is confirmed to have changed. But until the price breaks above this point, it's not confirmed. The reversal only becomes clear when this breakout actually happens. Only then is the bearish trend considered over. This is how Dow theory judged trend reversals. So did the price break out at this point? No, it didn't. The price failed to break through here. It tried to rally but fell back. But the good news is, during this pullback, the price didn't make new lows. No new lows were made, and then the price stabilized and rose for 3 consecutive days. What does this tell us? It means that even during the pullback, the sellers couldn't push prices to new lows. After that, we saw another bullish candle. At this point, bearish momentum is fading quickly, right? And bullish momentum is getting even stronger. This marks the right side of the pattern. That's the right shoulder. So generally, can you buy at this stage? Is it okay to buy here? Yes, you can, especially on these days, especially during these 2 days, right? But the reversal hasn't been fully confirmed yet. It still hasn't broken above resistance. So at this point, it's not the safest entry. Does that make sense? When is the best time to buy? It's when the price breaks through resistance. Why? Because this resistance is very strong. Take a closer look. See how many times price was rejected. Look at this area. Before the breakout, there were several failed attempts. 1, 2, 3, 4. Each time it failed, right? So only after breaking through here do we have a real opportunity. From a Dow theory perspective, the trend shift only happens at this stage. That's why it's best to trade the right side after confirmation. That's when you enter right side trade. So when is the left side trade appropriate? It's during these days when bullish candles appear. On these days, you can try a small position. Why? Because this is the left shoulder, showing that the downtrend is weakening. The left shoulder signals the trend is changing. When the right shoulder forms, it means the bearish momentum is clearly exhausted. That's called exhaustion. Bearish pressure drops sharply. The downtrend is losing steam. It's fading fast because the price isn't making new lows. If it did make new lows, that would mean the downtrend is still intact. But here, no new lows. And then we see consecutive bullish candles, 2 in a row. So during these 2 days, if you don't have a position, you can try a small test trade. Start with a small allocation. This approach is reasonable. However, the price could still drop from here. That's possible too. So this entry doesn't have the highest probability. Maybe there's only a 60% chance it works out. The odds of moving up from here are about 60%. If you want a higher probability setup, you need to wait until there's a breakout with strong volume. When price breaks above the neckline on high volume, that's a key signal for a valid reversal. Only then do we say the inverse head and shoulders is confirmed. That's when the reversal pattern is complete. Only then do we have confirmation. The inverse head and shoulders is valid. So make sure you understand this clearly. This is a classic way to trade the inverse head and shoulders reversal pattern. These are the key points for trading it. How do we judge the setup? At this level, can we enter? If you want a high probability trade, you should wait for the breakout. Wait until price breaks the neckline. Are there other ways to confirm the trade? Can we combine indicators to improve the odds? Is there a way to spot earlier entries and catch the move? Let's talk about that. Because sometimes some traders feel the breakout is too high to chase. They don't like buying high. Is there a way to enter earlier? Yes, there is. You can use the MACD indicator or the KDJ indicator. How does that work? If you see a bullish signal from MACD or KDJ at the lows, for example, a bullish crossover at the bottom, you can consider buying there. When you see a bullish candle, if there's a KDJ golden cross that day, that's an early signal. The KDJ golden cross may have appeared earlier. Did you notice that? Right? On this day, if you are a short-term or swing trader, when a bullish candle appears and you see the KDJ golden cross at the lows, you can consider entering here. A golden cross on the daily KDJ often means the rebound could last longer. Typically, the recovery lasts for a while. At that point, you might try a small position, just as a test. Buy a small amount, but this entry is a bit riskier. For example, if you see another golden cross later on, after previous death cross reverses and another golden cross forms here, at that point, you can consider entering again. Even if the price doesn't hit new highs, it still may have some room to run. It might keep climbing afterward. This also relates to the cycle timing, so you can use the KDJ indicator to guide ultra short or short-term trades. When there's a golden cross, you can try a small position. Test the waters at the point. Small positions are safer for probing trades. Of course, the odds are a bit lower, but the entry price is better. This approach is more cost-effective. So everyone can choose a method that fits their style. Choose what you're most comfortable with. If you prefer high probability trades, look for clear breakouts. Wait for the breakout to enter. You can also wait for a pullback and see if the neckline holds as support. If it does, you can buy them. This method offers a high probability, but you lose the opportunity to buy at lower prices. The win rate is higher, but you give up the early entry. If you manage large positions and want high conviction, buying on the breakouts is more suitable. If you just want to test with a small amount, early entries are also possible, but using the KDJ Golden Cross as confirmation is safer. If you want to prove with small trades, both the left and the right side are options. Using the KDJ Golden Cross can improve your entries. You may find even better timing with this method. Alright, that's it for today's lesson. We discussed how to use the inverse head and shoulders pattern to bottom fish. In the future, we will talk about how to use this pattern to identify exit opportunities. That includes selling or shorting with this pattern. That's all for today's sharing. Thank you.